All right, good afternoon, class. Today we'll be looking at income statement and the balance sheet. So today we'll be looking at income statement and balance sheet. All right, you won't be seeing me in this video. All right, so I'll be explaining all I'll be going through with you. So please, I'm asking for your undivided attention and see how best we can try to understand this. All right, so we're doing income statement and balance sheet, right? The income statement, otherwise known as your trading profit and loss. All right, so if you see first of which, you're seeing at the top there, you have ABC Limited. That is where you put the name of the company. So if the company was, say, Zuki Limited, that is what you would have put there. If it was ZY Limited, that is what you would have put there. So the first thing that you put is the name of the company, followed by income statement, right? So followed by the income statement for year ended December the 31st, 2002, right? So you'd have put the income statement for year ended and you put whatever the date, right? Whatever the period, whenever the period finished. So if it is December the 31st, 2002, or if it was a case that it was December the 31st, 2016 or 2007 or 2017, you just put the date right there. Now, the first thing that you've got to put inside the income statement there is your sales, right? Your sales. Now, from previous lesson, we would have already discussed sales. So when you look at the trial balance, you already know what a trial balance is. When you look at the trial balance, you'll see the sales, right? So you put the sales right there. Now, from there, you need to look to see if there's any return inwards. You need to look to see if there's any return inwards, right? Sometimes make reference to as sales return, right? Now, what that means is that any goods that the customer would have returned to you. So, take for example, you said you would have sold to customers goods for 500,000. If they return $50,000 worth of the goods from you, you'd have to subtract it, right? So, if you sell them goods for 500,000 and they had returned 50,000 worth of the goods, it therefore means that the true sales to those customers would have been 450. So that is all. That is what you're doing there. So you put in the sales. You need to look to see if there's any return inwards, or what we call sales return, meaning that goods that were returned to you. Now you minus that, the sales from your return inwards from your sales, assuming that your sales there was 50,000. When you minus that 50,000, assuming that your sales, was 500,000. When you minus the return inwards of 50,000, you're going to get what? 450. Now that 450,000 is known as what we call our net sales. That is what we call our net sales. So our net sales is when you would have minus your return inwards or your sales return from your sales. You get what is known as your net sales. Now from there you move into what we call this section, your less cost of goods sold, right? So this section is an entire header for it. Is what we call your less your cost of goods sold, right? Is what you call your less your cost of goods sold, right? It is okay to simply write less C.O.G.S, which is the acronym for cost of goods sold. Now for this section here, we're starting with our opening stock, right? So we're starting with our opening stock. Your opening stock making reference to what you have at the start of the period, right? What you had at the start of the period. Right, any goods that you had, any goods that you had from last year, right? So you have your opening stock. So your opening stock, let's say that your opening stock was 20,000. Then you add your purchases. The purchases there meaning that any goods that you would have bought within the year. So you'll find all of these figures. Bear in mind, you'll find all of these figures in your trial balance, right? So you add your purchases. So if your opening stock was 20,000, say for example your purchases was 180,000, right? So the 20 plus the 180 thus far give you what? 200,000, right? Then you add what is known as your what? Carriage inwards. Now we're going to explain carriage inwards for a minute here, right? Carriage, the word carriage there means transportation cost, right? Cost to transport goods. Now carriage can be broken down into two categories. One is known as your carriage inwards. The other is known as your carriage outwards. One is known as your carriage inwards and the other is known as your carriage outwards. The carriage inwards is added to your purchase price, right? The carriage inwards is added to your purchase price, right? So if you're buying goods from overseas, if you're buying, Carriage by definition represents cost to transfer goods to the company or cost to transfer goods to your customer. Carriage inwards looks at the cost to transfer goods to the company, meaning that cost of carrying goods to you. You buy the goods, you bought the goods, right? So you buy the goods for $180,000, right? But you'd have to pay somebody to drop the goods at your workplace or to drop the goods at your business, right? That is known as what? Carriage inwards, because you'd have to pay additional costs. So if you so happen to buy those goods all the way in Montego Bay, right, and they come up to $180,000, but you'd have to pay somebody $10,000 to take those goods back into Kingston to you. That would have known as your what? Carriage inwards, right? So it is added to your purchase price. We've got to be looking at carriage outwards also. Carriage outwards, you'll see carriage outwards reflected in your expense section. I can simply explain carriage outwards here and now. When you speak about carriage outwards, again, remember that carriage represents what? Cost to transfer goods, right? But carriage outwards would have represented the cost to transfer goods to your customer. So if ever you're transporting goods to your customer, it is known as carriage outwards. So you're incurring that cost. Now it's a marketing tool. Some companies may decide to incur that cost. So when a company say to you that, okay, we're selling you these items. So we're selling you phones, right? So you're buying phones from overseas and they tell you that, okay, free shipping and handling. So therefore you're not going to pay any cost for the shipping. They will ship it to you at their cost. What is therefore happening there is a carriage outwards, right? So they're incurring the cost or they're absorbing the cost to send those goods to you. So that is known as carriage outwards. All right. So we have explained carriage inwards and carriage outwards. So we're moving on there. So remember we had our opening stock, then we add our purchases, then we add our carriage inwards. All right. Now next we're going to look to see if there was any return outwards. We're going to look to see if there was any return outwards, right? Return outwards meaning that the goods that you would have purchased from your supplier, did you return any of them? Because if you buy X amount of goods, if you buy 180,000 worth of goods and you return 5,000 worth of goods to them, right? You'd have to minus that 5,000 from the 180 to give you your true purchase, which would have been 175 in that case. So that is why we subtract our return outwards, right? Return outwards, otherwise known as your purchases return. Right? Return outwards, otherwise known as your purchases return. Right? Now when you minus your return outwards, so your return outwards there is subtracted. Right? Your return outwards there is subtracted. All right. So you minus your return outwards. You minus your return outwards. When you minus your return outwards, right, that figure where you're seeing those X below, right, where you're seeing those X below, that figure is known as your cost of goods available. Right? So that figure is known as your cost of goods available. It is known as your cost of goods available. It is known as your cost of goods available. Right? Now when you get your cost of goods available, the next thing that you do, you're going to look in the trial balance to see if you see your what? Your closing stock. Got to look to see if if you have any closing stock. Now the closing stock will oftentimes appear 9.5 times out of 10. You'll find the closing stock below the trial balance, right? So therefore you'll find it in the footnotes. You'll find the closing stock in your footnotes, right? So you'll find the closing stock there in your footnotes. You'll find the closing stock figures there in your footnotes, right? Now what you do, you subtract your closing stock figure from from the figure which is known as your cost of goods available. So you're going to subtract your closing stock figure from the figure that is known as your cost of goods available, and then you'll get what is known as your cost of goods sold. So remember that we had a header right there. So everything that you do right there is to get that little that thing in the bracket there, right? That figure that we call your cost of goods sold, right? So everything that you do is to get that figure there, which is known as your cost of goods sold. Now that cost of goods sold figure, which is below, if you realize it's below your net sales, that cost of goods sold figure is subtracted from your net sales, right? So the cost of goods figure is subtracted from your net sales. When it is subtracted from your net sales, that figure that you get below is known as your gross profit. All right, so the figure that you get below is known as your gross profit. The figure that you get below is known as your gross profit, and you can see those dots merging them across, right, to give you that figure that is known as your gross profit. All right, your gross profit, otherwise mentioned as your trading profit. Now, next of which we're going to look in the trial balance to see if there were any other revenues. When we started our class, we spoke to you about other revenues, meaning that revenues that come through that the business would have earned through secondary source, right? Through secondary source, right? Through them side business, etc., right? Or any other revenue that the business would have generated. Now, examples of other revenues, there we have what is known as rent received. That's an example, right? So rent received, if there was any, you put the rent received there, you put your discount received, you put your commission received, right? We did a video as it relates to bad debts and provision for bad debts. If your provision for bad debts had reduced, meaning that there was a reduction in provision for bad debts, it is seen as other revenue, so that it would have been included there, right? So what you would have done, you would have add up all of your other revenues. Right, when you add up all of your other revenues, so take for you add your rent received, your discount received, your commission received, and your reduction in provision for bad debts. Take for example, you got $5,000. When you add up all of those, you'll put that total. That total of that $5,000 there is put to your right. Right, it will be put to the right. You put the total there of that $5,000 to the right. Right. Now that $5,000 there is now added to your gross profit, right? So it is added to that figure that is above. Will be added to that figure which is above, right? Known as your gross profit. Now if your gross profit there was say 100,000, when you add that 5,000 to that 100,000, you get what? 105. So therefore, when you add that 100,000 to the 5,000, the 5,000 we're speaking about represent the other revenue, for example, right? You get 105. Now from there you can move into what we know as the expense. The expense section, right? So the expense section, what are we doing with the expense? We're going to minus our expense, right? We're going to less our expense. We'll be subtracting our expense, right? Now in the expense there, so there expense meaning that operating expense, any expense that the business would have incurred, right? So those expense that we spoke about, revenue expenditure. Remember that we did capital expenditure and revenue expenditure, right? So these are those revenue expenditure. Now if you can look here, you're seeing that we have the expense there, right? Now because we didn't have enough space, you realize that I would have grouped some expense. So you say I have rent, salary, utilities, office expense, right? They would not be listed across. They will be listed below each other. So you'd have had rent, you put in the rent figure. Then below you have salary, you put in the salary figure. Then below you have utility, you put in the utility figure. Then you have office expense, you put in the office expense figure. Right, so that is how they would have been listed there, right? Next of which you have what is known as discount allow. Now we did discount allow when we were doing 3-column cash book. So you know that discount allow is a what? Expense to the business. So discount allow is also included there, right? So discount allow will be included there. Then you have your what? Carriage outwards. So you look in the trial balance also to see if there was carriage outwards, right? Then you have your carriage outwards. In no particular order, you don't need to list these, right? So you'd have had your carriage outwards. Now we need to look to see if there was any other expense, right? Also depreciation. Remember that depreciation is an expense, right? When we did depreciation, the lesson on depreciation. Now what goes here? The depreciation charge for the year. So whatever the depreciation charges for the year was, or whatever the depreciation charge for the year is, that is what you're going to put right there. Right? The depreciation charge for the year. Right? So you're going to depreciate your fixed asset. And let's take, for example, that the fixed asset that you had right there, in the question was motor vehicle. You've got to find the depreciation charge for motor vehicle, whichever method that they're saying. So if they say the straight line method, you've got to calculate it using the straight line method. Also for premises, also for equipment, and any other fixed asset that they would have given to you in the question. Right? You'd find the depreciation for them, right? And of course, you're not going to merge them together. It is because we're pressed for space right there. So you'd have a depreciation for motor vehicle, you put the depreciation for motor vehicle. Now below, you would have a depreciation, then you have premises, you put the figure for premises. Then below it, you would have had equipment, the depreciation for equipment, you put the figure below. Alright? Now what we'll be doing here, what you do right there, you're going to add up all of your expense. So you're going to add up all of your expense. Right? You're going to add all of your expense. Now when you add up all of your expense, right, you'll get a total, right? When you add up all of your expense, you're going to get the total. Now that total you're going to put to your right. Right? You're going to put to your right, right? And that is the total that you see there in the bracket. In the bracket in red, you're going to put that total to your right. And then you're going to subtract that total from the figure that you have above. Now remember what was that figure above? The figure that we had above was our gross profit plus our other revenue. Would have given you that figure that we have above there, right? So now you're going to minus your expense from that. Now when you minus your expense from your adjusted gross profit, so we call it the adjusted gross profit, because you would have had gross profit and you would have made adjustment to it, meaning that you add revenues. If there were any other revenue, you would have added it. So you would have got your adjusted gross profit, right? Now you're going to minus your expenses from them, and when you minus your expense, you get what is known as your net profit, or what we call our net loss. Now if we're assuming there that let us assume that our adjusted gross profit was, say, 105,000. Right? Now when you add up all of your expense, you get 20,000. Now 20,000 minus that 105,000, right? 20,000 minus the 105,000 would give us, the 20,000 minus the 105,000, there would give us what? 80,000 or 85,000, my bad, right? Would give us 85,000. So it therefore means that your net profit is 85,000. It therefore means that your net profit is 85,000. If it was a case where when you add up all of your expense, let us say that you add up all of your you add up all of your expense, right? Assuming when you add up all of your expense, you did not get 20,000, but rather you get 110,000. Now you'd have had what? 110,000, and you're going to minus 110,000 from the what? 105, because remember that we're using in this example, saying that the gross profit there was 105, right? The adjusted gross profit is 105. Now when you minus 110 from 105, we'll get what? A minus 5,000. No, right, we'll get a minus 5,000. Now that is signifying that the company did not make a net profit, but rather they made a net loss of 5,000, right? They would have made a net loss there of 5,000.